Yo, how'd I get one of those V-necks, man?
Dude, this is see, it's cut down.
Oh,
What's
it's
going
not
on,
even a
everybody?
V-neck!
What's going on, everybody? This is Mailbag here. We are here with Lucci and Brian Weiner. Obviously, he's admiring my. He thought it was a V-neck here because it kind of looks like it, but it just hasn't been washed in a while.
Oh,
So
that's that's good.
it's kind of what it.
Good contrast with the background, too.
What's up, everybody? This crazy market, this crazy market. We saw a bounce today after this morning. I mean, Brian, when you pulled up everything this morning and you saw everything that was going on this morning, what did you think, man? What did you think?
I was surprised it wasn't worse, actually.
Yeah.
We price sign kind of hung in there. It hung in there. It could have been fucking buck wild below 1,000 or some shit.
It could have been bad. It could have been bad. It could have been bad. Now, notice I haven't told anybody what my positions are, Brian.
Well, I didn't say what it was.
Anyways, yeah, so there was a lot of gap downs. We saw a monster rally yesterday, and then a crazy gap down where Europe was falling apart, Ebola virus panic picking up, and all these kind of things hit the newswire this morning. And futures this morning, I guess it was just no liquidity, which is why it was so easy, to push these things down. Have you ever sort of been in a market where, you have that light liquidity on the ES and you just get these crazy moves overnight here, Brian?
Overnight, I mean, like 9/11. We'll go with that one.
Okay.
But it does depend. Depends on the time of the year. The thing about it is people are widening out because where's the bottom? The bottom is very far away.
Right.
We've been riding this trend, so I don't blame people for widening out. You're a market maker, but you're not a fucking a scapegoat. You know what I'm saying? You're not a P&L provider, so whatever.
Right. Right. So, and then anybody who looked on Twitter, it was just Armageddon. It was Armageddon everywhere, and that was really it. So, this morning I kind of came in pretty bearish, and then all of a sudden, right off the open, I saw the spike up to 185 on the SPY, and I'm like, dude, I need to go ahead and buy some more stuff down here. So I went to work. I had a pretty crazy day. I've had a pretty crazy week, everybody. Good thing is I'm still alive here. I'm up on the month, so everything's going well. Go ahead and interact on Twitter if you guys have any questions. We're gonna go ahead and take a bunch of questions from the mailbag here. Brian, anything you want to add here before we get cracking?
Nah, man, I'd just say take advantage of this volatility because if you want to get in, you can get in. If you want to get out, you can get out.
Definitely. I would also add to that, stick to names that you actually can,
Yeah.
Obviously, we're talking about this price line. It's tough to get out. It's tough to get in and out of this thing. I mean, most options, you got a point spread on the damn thing. So a lot of newbies, you can't really trade that stuff.
You got to be comfortable with what you're trading in a volatile environment. I'm not going to step into fucking CMG right now.
Yeah. You know what? Yeah, you know what? When with the range on the ES, like you're getting crazy ranges on SPY. And so you could literally just trade the SPY here and just go with the Momo. Have you noticed too? And this is one thing that I that I wanted to throw out there to everybody was that it's Thursday today. SPY options, out of the money weekly calls and puts on any SPY contract was worth a lot of money. Like there was a lot of volatility priced into these things. So you're talking about 2 points, 3 points out of the money, and these SPY calls and puts are worth like $2. You're paying $2 for these things, which is absolutely nuts. So that just goes to show you the range is pretty wide right now. So that volatility is starting to get priced into.
Well, let me tell you really quick.
Sure.
Okay. So obviously the VIX spiked. I don't know where's VIX at right now. I don't know where it is.
VIX is probably under 30. It's probably under 30. Yeah, it's at 25 right now.
All right. So 25. All right. So usually SPX vol is like around 12.
Right.
So A, that's going to make the prices way more expensive now, but B, because it's Thursday, there's so much decay, okay?
Right.
So if we have whippy moves, it's like a juxtaposition. It's like, well, the vol's too high, but we're moving,
Right.
like Netflix dumped a shitload. The vol was very high from last night, but the straddle only came in like 8. I mean, the vol didn't even come off because it moved, and then it moved again.
And then it moved again after it
opened. So you got to be actually on the right strike.
Yep.
That's the thing. You got to be on the right strike. If you hedge stuff, you got to hedge with the right thing. It's very particular right now. You know what I'm saying?
Definitely.
So it's
Definitely.
tough.
All right, guys. So again, interact on Twitter. If you have any questions that you want us to answer live, just go ahead and throw them out on Twitter. I'm actually going to take one that we got on Twitter. Let's see if I can find it. Who do we got? Who do we got? Who do we got? Where is this thing? Oh, okay. We got at Trabuco Roble. Trabuco Roble. I don't know if that's his name.
Sounds like your cousin.
But that's not an Indian name. It doesn't sound Indian. Oh, saying Lucci, you mean? All right.
No, like the rubble. Like, I don't know what the fuck I'm talking
about. All right. So he's saying, do you find it necessary to take on positions in a longer list of contracts/stocks to execute your strategy? Me personally, no. But it also depends on the environment. You know, so for right now, when things are so volatile, when you look at too many names, since things are going absolutely crazy, it's too much to focus on. You know, you really got to just narrow down on a couple. But when you have, let's say, a market that is not going to rally or dump 40 handles on you in one freaking day, then you can build a little bit of a portfolio and you can add, you know, you can add some shorts, add some longs, and you can slowly kind of work into these things. But once you have a market that is moving as much as this, it's too difficult to focus on several names. That's what I would say. Brian, what do you got? I mean, it's different for you being the market maker.
You know, it's just about, I look at completely different things, but, you know, again, just to reiterate, when you're on a normal, you know, basis, you're looking at sector rotation, and that's when you want to do what he's asking.
Right.
Aside from that, you just kind of want to sell things that have gone too high and buy things that have gone too low, even if they're in the same sector. You know, the thing about this volatility is that when things are volatile, the very, you know, the beta is quite high, and so things are kind of correlated. They move the same. So that's when you have some arb. You know, basically you're arbing. Some guy wants to do one thing in one name in the same sector as something some guy wants to do another thing in another name in the same sector, and so right. You actually have an opportunity to put on a spread between two different products.
Right.
You know, but be kind of market neutral. So
absolutely.
You look for those things.
Cool, cool. And then his follow-up question is, do you ever feel hindered or that your attention and focus effectiveness are diluted over too many positions? Me personally, yes. Why? Because I'm very concentrated. You know what I mean? We're talking about concentrated positions. So if I'm knee-deep in Priceline, for example, you know, I'm up and down hundreds of thousands of dollars, and just from that mental the taxing, you know, that kind of position takes on your mind, you become less effective trading other things. You become, you know, less effective with your entries and exits on other things. So I would say that for there. I mean, Brian, do you get out of control here when you got too many positions? You're pretty much market neutral.
I like more things. Like, I like it busier. So what I do is I just look at the Greeks. I'll look at my delta, which should be neutral, unless I have a bunch of gamma, whatever. Look at my vega and my theta, and what I want to do is kind of keep those neutral unless I feel like we're moving in a certain direction, and it's good to have a position on. The thing is, if I have too many names if I have too many expiration cycles, then that's where I get that's where it's very complex. Is I have to deal with this weekly, that weekly, this monthly, and that's right. Where things get complicated for me.
Okay. Okay. All right, so we got another question here from Luke Mace. He's got two questions. I had a credit spread set on gold and set it while VIX was at 28. I know that with increased volatility, the parameters change to make a move become more profitable and also more costly depending on the swing. Observing the price and decreasing VIX, I noticed that even with price hitting a point that put me minus $40, let's say, and with the VIX decreased to about 26, when the price level was touched again, it was minus $60. So my question is, in theory, with decreasing risk, shouldn't the parameters adjust to it as well, so less profit and loss are to be expected with price movements? Not saying if the trade is 200 to 700, the risk reward should change, but doesn't the price move need to be lengthened as well as compensate for the lowered volatility so it doesn't hurt me as much when the VIX was higher? This is a very complicated question. Did you understand a word?
No, I would love to actually read the thing. If he can send it to me at Dirty Automatic on Twitter, I can actually figure out and probably analyze that. Have them send it.
Yo, Eric is here watching too. Eric, go ahead and copy that. Go ahead and copy that. Send it to Brian on the Skype. See if he can get it before we cut out.
Yeah.
Second question: to buy a call at the bottom of a sell-off is not usually profitable due to the implied volatility drop versus price increase. What contrarian trades are the best in these high implied volatility scenarios besides selling spreads? I mean, I personally disagree with this, though. He's saying to buy a call at the bottom of a sell-off is not usually profitable. Is he saying that because you got to time it right? I mean, what's he saying that for?
Let's just put it like this. All right. So depends on what call you're buying. If you're buying a 20 delta call, yes, it's not going to be that great. The thing is this is complicated. All right, so it's the delta. Now, if the stock rips through it, it's going to be profitable. If
no
you
matter
buy
what.
it, you know what I'm saying? But if it's like slow, if it hit the bottom and it slowly drifts up to that 20 delta call after a big move, then you're not going to reap the reward that you're expecting. Now, here's the thing: when we dump down, the vol goes up. Okay, when the vol goes up, the delta goes up. So that 20 delta really is not a real 20 delta. It might be really like a 12 delta. But because volatility is a factor in the delta creation that you see, you know, you're gonna get a bigger delta. And if the volatility comes down, that delta actually, as we go up, is going to decrease. As strangely as it is. So that's actually a trade where you want to sell a call, buy stock, and hedge it.
Right.
I guess what I would say is I would sell in like a 70 delta put. You know, not even spread it. Just sell a 70 delta put, buy some crappy put against it, but. You know, if you want to buy and you don't want to buy stock, buy a 100 delta call that has no volatility input really.
In it. Right.
So it's what you buy is what's important.
Absolutely. And another way to answer this question from, let's say, my world, from the folks that, let's say, aren't as options minded as Brian here. Again, like I come from a tape reading background. So if I'm sitting there looking at the tape on a monster dropout in a stock, and I'm looking to sit there and pick up bottoms, but I'm sitting there looking at the price action, and even the bottoms aren't being picked up aggressively, or for whatever reason, buyers aren't really coming back into the trade, even though it might be floating higher. I know immediately just through the price action that I'm not going to make a freaking dime on those calls. I either need to be in stock, or maybe just go ahead and sell some puts. When I feel like it's bottomed out, maybe go far out of the money and start selling some puts. So that's how I would go ahead and look at that trade or that scenario. Let's see, what else we got? What effect did the news reports about Ebola have on the markets dumping? I saw a lot of references on Twitter. I think it just added to the overall panic at the market. Like, it was perfect timing, you know what I mean? Like all these Ebola cases. By the way, did Peter tell you there was a case in New Haven that popped up?
I heard all about it on that Slack,
Yeah, on that Slack, baby.
Gamba is frantic, man. Gamba's taking cover.
Yeah, so there's cases in New Jersey, I believe. There's cases in New York, and then there's one, I guess, our boy Peter Zhang found out about in New Haven. He hit me up this morning about it. I'm like, dude, shut up, man. She got the influenza, man. Shut up. It's not happening.
A food bug, and it's like, oh, I got Ebola.
So I would say it just added to the panic. It added to the panic. It added to the fear. And anytime there's fear and panic on the street, there's blood. There's blood everywhere. And obviously, you guys have seen it as well. It got pretty disgusting in the past couple of days. Another effect it had was those penny stocks. There was a couple of penny stocks that really just popped to the moon. I think one of them was LAKE, Lake. There was an APT, I believe. That was another one. Like, these are all called the Ebola stocks, and they all kind of went to the moon. So, you got that as well. Next question here. What do you think happens next to Netflix now that it's dumped 100 points? What do you think, Brian?
Wow, I don't know, man. I think last time it was around 360, it kind of oscillated quite a bit, man.
Yeah.
It's like we're in this little hilly area.
Right.
You need to have a big you need an icon to come back in or some shit. He's like, oh, it's a discount. He probably bought it at 330. His son was probably like, yo, we're going back in.
Definitely. I would say it's very ironic that a move started the Netflix pump from $100. From $100, they were talking about the House of Cards and everything, and then the earnings call came out. Nobody was even talking about Netflix, and those calls, Brian, they were worth like 15 cents. The highest call that you could buy was worth like 15 cents.
He bought this and that and that and that and that. It was like $68. I remember
And then it opened above, like it opened 10 points above the highest strike, and that started the move. And all of a sudden, we were at $250, like in minutes. And now all of a sudden, because of subscriber misses, and it wasn't even that big of a subscriber miss. You're talking about 100 and change. It was like 120 points at one time. So obviously it was overdone, guys. Obviously it was overdone. Everybody started picking this thing back up too today. This thing got back up to 361. But as Brian said, it's la la land. You got to wait now. You got to wait. You got to give it some time. And we're also at an uneasy place in the market too.
Yeah.
There's no guarantee here that we're going to go back to all-time highs. By the way, Brian, do you think we'll go back to all-time highs?
It kind of looks like we peaked out, like on that Price is Right, where that Norwegian guy is going up on the thing, and then he falls down, and it's really hard to win after that because you can't.
Right. All right, so let's take one more question here. There was another one. I want to play earnings, but I don't want all the risk. What can I do? I'm gonna lay that off to you. So let's say you want to play earnings on, anything, not necessarily the crazy high flyers.
I got it.
Yeah. What would you do?
All right. Well,
you don't want all that risk.
First of all, is two types of risk. So there's risk in the premium, and then there's risk in a directional move. So with risk in the premium, you're obviously going to have to sell something against buying something. So like yesterday, I thought Netflix was going to go to the moon, so I bought the 480-500 call spread. I only lost $1,000 because I, bought the 480s and sold the 500s at the right time, and it wasn't a big deal. So I wasn't pissed when the stock actually moved up the amount that I needed it to, but in the wrong direction. I was like, screw me, whatever. So, instead of losing 2,500, I lost 1,000 or whatever the case may be. Now, say you think a move's not going to happen. You don't think Netflix is going to move. So you see the straddle's kind of expensive. You might sell the straddle. Yesterday was like the 4.5 straddle. So the 4.5 straddle, you buy like the 4.25, 475 strangle against it. You cut off your loss right there, and that saved your bank account. You might actually buy two 4.25 puts and buy two 475 calls against it. You still made money on premium if some kind of weird move happened, and you make money once we break 400. You would have made money down to 330. You know what I'm saying? So you can net collect premium,
right?
If you think we're not going to move, or you can net pay less premium by selling something else against your directional bet or your volatility bet. You could buy the straddle, sell a strangle. So it's all about, can you sell options, and that's really the only way that you can hedge this.
Right. That's a good precursor right there. The question is, like, when you do play earnings, let's say you got a 5K account, you got a small account, and you can't write these options. Well, taking the risk out of the game right there, Brian, would seem pretty difficult.
Yeah, I mean, yes, in order to hedge, you need to do the exact opposite. In order to hedge perfectly, you need to do the exact opposite of both parameters, direction and premium. So if you can't do that, then you're partially hedged. Like if you think we're going up, but you're not sure, so you buy a put against it, well, now you're premium hedged. If Netflix didn't move, you're going to lose money on buying that straddle. If Netflix does move and you sell the straddle, all right, so if Netflix goes down like it did today instead of up, and you thought we were going up and you weren't able to sell a higher call against it, you lost all the premium as opposed to some percentage of the premium that you wanted to lose in that directional bet. So again, you have to suck on the premium pretty much if you can't sell options. You can trade some minis if you can, so it's like, maybe I'll do 2 mini options and I'm part of the game at least a little bit, which is cool, and it's like 1/10 of the amount of capital. But if there's no many options, then yeah, you're gonna have to suck on it if you can't sell options, you know.
Definitely, and guys, this is a perfect segue here to what we got going on tomorrow. Brian is going to do his first sort of options webinar here tomorrow. Unfortunately, this is not being shared properly. Why does that always happen, huh?
Google isn't perfect. That's probably why it puked 5%, which I already calculated with that move. It was going to be 5% move, and that was the low on MarketWatch, by the way.
Right.
Google is imperfect. It doesn't even know how to bring up spreadsheets properly, and that's the problem that we have currently.
Okay, well, I'm going to bring this up. Can you see this, Brian?
Mm-hmm.
Okay, that's great. So here you'll see a large landing page here for Brian's webinar tomorrow. He's going to be introducing the training program that he is currently offering through St. Lucci. It's going to be tomorrow at 4:30, and it's going to be about managing your options risk. So exactly what some of the questions we were alluding to today as far as volatility goes and delta goes. And guys, one thing I want to mention here is that, again, like my class is more on teaching you, how the market works through price, and then understanding the options game through simple kind of common sense approach. Once you want to get a little bit more advanced, and you really want to understand options and all the different metrics that determine the prices that you see, and also hedging, and a lot of these other spreads and things like that. This is the class that you want to take here. So, Brian, why don't you give us a little spiel here on tomorrow's shindig?
Right. So we're going to kind of talk about what I mentioned today. It's about you have a goal. You have a goal to take a directional play, or you have a goal that we're not going to have direction, or the direction is going to go opposite opposite of the position that you put on. And what you can do is that you can hedge that risk. You can hedge that directional bet because you're going to be buying premium with a directional bet, or you're going to hedge your selling option risk. So right. We'll talk about those two things, and kind of breaking down the two different P&Ls that you get.
Right, absolutely. And guys, I have also benefited directly, from a lot of what Brian has taught me, about managing my options risk. Obviously, you guys know I'm pretty, I'm concentrated in a couple of things, but sometimes I might be wrong in these scenarios, and you gotta start accounting for that if you want to, minimize that risk and create that P&L chart that, you've been looking after. So everybody check out tomorrow at 4:30. We have a link. We'll drop a link in the YouTube link, and then again, just pop on Twitter, and you'll find the link there to register. Anything else you wanna shoot out on, Brian?
So back to Luke Mace, I would suggest, anyone, to shoot me a question on Twitter at Dirty Automatic with a K, because that's how I do. And I'd like to know more about this trade because it's a little cryptic. I need to know the exact situations and the price and stuff like that. Because again, all I know in my life are options, and let's talk about it. So let me know.
Awesome. Brian's also going to be taking questions tomorrow too. So anybody who has questions about managing risk through options, about creating spreads, about what you can do in X, Y, and Z scenario, come hungry to the webinar tomorrow and have a nice conversation with our man Brian. All right. All right, man. Take care, man, and I will see you. I'll see you tomorrow, man. It's going to be crazy too.
Patriots, baby.
All right, man. Later.
Later.